Hello, I'm Caldwell, and this is On the Money, a weekly look how to get the best out of your savings and investments. So last week I was on holiday in Wales. I was trying to switch off from work. I deleted all the social media apps that I've got, but then a news alert popped up on my phone reporting that a big stock market sell-off had been taking place. So when the stock market makes the front pages of the broadsheets, it can cause people to naturally panic. But as history shows, for those that are willing to take a long-term perspective, stock market sell-offs are par for the course and end up being a mere footnote in the grand scheme of things. Indeed, at times of stock market turbulence, it's worth remembering that volatility is part of the deal with investing in equities, and it is arguably the price that investors pay for the fact that over the long run, putting money into shares rather than leaving it in cash has historically yielded greater rewards. However, over short time periods, sell-offs can be painful. At the same time, however, they can also bring opportunities. So for this episode, the focus is on discussing the reasons behind why the stock market sell-off took place and the potential implications for investors. Joining me to provide his expert insights is Richard Hunter, Head of Markets at Interactive Investor. So Richard, there have been several reasons attributed to the stock market turbulence that played out earlier this month. The first was weaker than expected US economic data. Could you explain why this panicked market and raised fears of a potential recession in the US?
Yeah, hi Kyle. The initial trigger for the sell-off was without question the release of what's called the non-farm payrolls report in the States. It's a monthly summary of where the unemployment rate is and how many jobs have been added for the previous month. It's arguably the one piece of economic data which receives the most attention around the world. And what happened Friday before last was that the figure came in much weaker than expected. This was following a similarly weak manufacturing print from earlier, a few days earlier. And all of a sudden, investors decided, because that week had also seen the Federal Reserve decide to leave interest rates unchanged yet again, investors all of a sudden decided that, hold on a moment, has the Fed missed the boat? Is the economy contracting rather quicker than we expected? And by missing the boat, are we now heading for recessionary territory as opposed to the economic soft landing which investors have been anticipating for some months?
And sticking with the US, another reason that I've seen being cited as playing its part in the sell-off is concerns that the biggest US technology companies, the so-called Magnificent Seven, are trading on valuations that have become potentially overheated. And if their earnings disappoint, then there would be some more air kicked out of the tyres. So prior to the sell-off last week, we've already seen since mid-July some signs of a possible rotation out of some of the US tech giants into areas that have not performed well over the past couple of years as interest rates have risen, such as smaller companies. And we've seen over the past month the likes of Nvidia, Apple and Microsoft. They have seen some notable share price declines. Of course, if you're looking at a longer term view over the past 3, 5, 10 years, that trio of companies have performed incredibly well. So what are your thoughts, Richard, on the outlook for the US technology giants?
Well, you're right in your summary, of course. The other thing to add into the mix is that we are bang in the middle of the second quarter half-year earnings season. And so all of the Magnificent Seven, except Nvidia, who report in a couple of weeks, have now updated the market. There's certainly nothing there to put the cat amongst the investment pigeons particularly, except that we're getting to a stage where expectations are so high and so much money has been invested towards AI that we're going to see investors increasingly looking for some kind of payback. So on a quarterly basis, it's going to be increasingly difficult for tech companies, particularly the mega cap tech companies such as the Magnificent Seven, to surpass expectations until such time as some of that profit starts to filter through, and at the very least revenue. And that's roughly where we are. In terms of US tech generally, I don't think you can argue against it. There are some geopolitical concerns on the sidelines as well, where the US and China are looking to ban each other's products from sales in the country. That, incidentally, applies to a couple of US tech stocks in particular. But again, for the longer term, I think the US tech story remains in place. But in terms of valuations, it may well be that stocks are up with events for now.
I mean, a lot of the comments that I receive in my inbox from fund managers are hopeful that going forward, the US markets will become less concentrated and that there will be a broadening of performance. It won't just be these 7 stocks continuing to dominate as they have done largely since the start of 2023.
Yes, you're absolutely right. And as you mentioned, we have seen something of a rotation over the last month or so. Obviously, smaller companies are more impacted by higher interest rates because they rely on having to borrow money to grow their businesses, which certainly isn't the case with the mega cap technology companies. That being said, in terms of last week's sell-off, it was fairly broad brush. And the Russell 2000 index, which had been on something of a roll as a result of that rotation, also took something of a bath.
It was interesting to see that Warren Buffett has reduced his exposure to Apple. He's been tight-lipped, so we don't know the reasons why he has cut his stake. What are your thoughts, Richard? Do you think Buffett increasing his cash pile has contributed towards the sell-off that took place?
I don't think it would have been helpful, but obviously Buffett is someone who continues to run the slide rule over his biggest investments. We've just been talking about US-China relations, and that tetchiness between the US and China has had an impact on Apple. It's very possible, of course, he was simply looking to lock in some profits, and he usually makes these moves ahead of any market gyrations, and it looks like he's got it spot on yet again.
And as a proportion of total assets, Buffett's cash pile, it's only been higher once, which was in the years leading up to the global financial crisis. This has prompted a lot of news headlines, which may make people quite fearful. What's your view on that, Richard?
At any given time, there are things working against the market and against investors. We've seen an escalation of the problems in the Middle East, for example. We're still not necessarily out of the recessionary woods yet for the US, although things are looking slightly brighter. We've just mentioned the punchiness of tech valuations. We've got this ongoing standoff between the US and China, particularly when it comes to technology. And a lot of this, unfortunately, tends to revolve around market sentiment. Market sentiment can take but a second to break and to turn into the opposite direction. At that stage, you need to bear in mind that market movements tend to overshoot in both directions, as we very much saw last week. So we're going to have to see whether Buffett was right on Apple individually. If he'd liquidated his whole portfolio, that would certainly be a big red flashing signal.
We're now going to turn our attention to Japan, which incidentally is a stock market that Buffett over the past couple of years has been finding value in and increasing exposure to. What sort of made the sell-off worse was the fact that the Bank of Japan raised interest rates. So compared to where they are here in the UK, interest rates are very low in Japan, but they were raised to 0.25%, up from the previous 0% to 0.1% range. What happened here was the increase in interest rates caused the Japanese yen to strengthen, and in turn, this negatively impacted equities, particularly the Japanese stock market. Could you explain how these two are linked, Richard?
The Japanese stock market, the Nikkei, definitely bore the brunt of market volatility last week. At its worst, it was down 12%. That was just on one day, although it bounced back around 10% a day or two after. There's a couple of factors at play here. You're right. The fact that Japan raised interest rate over a multi-decade period did necessarily give the yen some strength. What also happened was that the shocking non-farm payrolls figure from the States and the possibility of recession, or so investors thought, caused the dollar some weakness, which meant that the yen strengthened further.
And Richard, central to this is what I've seen described as the yen carry trade unwinding. Could you explain what that is?
Now, the carry trade is basically a tool which investors use to borrow as cheaply as they can, which historically has been Japan at next to nothing, and then invest those monies elsewhere in other assets, usually stocks. So there's clearly a couple of pressure points there. If the yen rises or those alternative investments fall, then people are all of a sudden looking to get out of that trade. And of course, both of those things happened together last week. And that's what caused this unwinding of the carry trade, although thankfully it was fairly contained. But it was the Japanese stock market which took the brunt of that. And another reason for that, of course, is that in terms of Japanese companies generally, they prefer a weaker yen because they're so reliant on export.
So Richard, I think we've covered off the main reasons that have all contributed towards the sell-off, which are fears of a potential US recession, potential fears over the valuations for US technology shares, particularly the biggest companies, and the strengthening of Japan's currency, the yen. Do you also think that the fact that the sell-off took place in August may have been a factor? I mean, in the summer, of course, there does tend to be thinner trading volumes, which in the past, well, historically, it has been blamed on exaggerating sharp sell-offs in the summer months.
Yeah, that's also a factor that's playing into this. Lighter volumes mean that volatility is immediately heightened, and it doesn't take too much to push investors over the edge one way or the other because there's limited liquidity. So that kind of thing would also have played into the fact that certainly over the course of a day or two, it seemed that some investors were rushing for the exits at the same time.
And looking ahead, as you mentioned, Richard, the stock market sell-off, it did not last for long. We saw later on in the week, stock markets start to recover. So what's your thoughts and outlook for stock markets over the next couple of months? Is your glass half full or half empty?
I have no idea what's going to happen over the next couple of months, and anyone who says that they does are not telling you the truth. It's another reason to be taking the longer term view. What I do know is that if we look at last week on the whole, the start of the week and the end of the week, the history books will show that the market didn't move that week. Each of the three main US indices, for example, were flat or down about 0.1%. Of course, the history books there won't be revealing the turmoil that was underneath it, but it was almost a week that never was. And it was a couple of strange things that happened that changed that sentiment again. There's this thing called the initial jobless claims economic release in the States, which is released every Thursday and normally doesn't garner much interest at all. But coming on the back of the non-farms figure, all of a sudden, it became a very important data point. And it was better than expected. So all of a sudden, perhaps the US isn't heading into recession anymore. And that followed a pretty good service sector report. And of course, the US consumer is estimated to be responsible for about 70% of US economic growth. So all of a sudden, the game had changed. Quite by the by, there were also a couple of strong company announcements which undid some of the weakness, and indeed most of the S&P 500 have now reported and have beaten expectations. So that's not to say volatility's gone away. It could easily be reignited. For example, this week we've got some important inflation and retail sales figures coming out of the States, and if they were to go in the wrong direction, we could see volatility come back to hit us again, because what's been happening in the interim is that the markets had expected 0.25% rate cut from the Federal Reserve in September. During the height of the turmoil, all of a sudden that became 0.5% at the least, and even potentially an emergency intra-meeting rate cut by the Fed, both of which dwindled largely by the end of the week. So with the lighter volumes you mentioned, volatility is not far away. Let's see how the next couple of economic prints come through.
And a final observation for me is reiterating what I said at the start of this podcast, that it's important for long-term investors to keep a cool head and not panic when there is a stock market sell-off. Over time, as history has proven, stock markets do recover. So if you have broad exposure through an active fund, or you passively own in a particular market or a number of markets through index funds or ETFs, over time, the bumps in the road will very likely be smoothed out. I do think with individual shares, when a company sees its share price fall, notably for a very specific reason, then more care needs to be taken, as over time, not all shares recover. But if you've got broad exposure to a market and you're diversified and having a well-balanced portfolio, then you are well equipped to ride out short-term market falls. My thanks to Richard, and thank you for listening to this episode of On the Money. If you enjoyed it, please follow the show in your podcast app and do tell a friend about it. And if you get a chance, it'd be great if you could leave us a review or a rating in your podcast app too. You can join the conversation, ask questions and tell us what you'd like to talk about via email, which is otm@ii.co.uk. And in the meantime, you can find more information and practical pointers on how to get the most out of your investments on the Interactive Investor website, which is ii.co.uk. And I'll see you next week.